When is the right time to sell your business? How does the process work? And what does it really take to get to a final exit? In this video, we will answer those burning questions. And today, I'm joined by fellow growth thinker, Eddie Clay, who's the director and co-head of investment banking for Growthink Capital. Eddie, welcome to the show.
Tim, happy to be here.
So, Eddie, we have a lot of conversations with business owners on a daily basis who are starting to consider an exit. And some of the most burning questions that they have are if, when, and how to sell their business. Is it possible for me? Is the process long? Is it expensive? So I thought we can spend some time here and demystify the process just a little bit. And I wanted to start with, what are the elements of a business when they look good and ready to hit the market?
Yeah, that's one of the magic questions, Tim. I'm sure that a lot of business owners struggle with trying to figure that out and trying to understand timing and when's a good time to sell, when's not a good time to sell, how to maximize value in a sale. And, the reality is it's a competitive market for buyers, and they are pretty disciplined in their approach to buying companies. The buyers can be financial buyers, they can be strategic buyers, which are usually operating companies, often competitors of the client or the company is trying to sell. And what they're looking at is a long list of metrics for the company, also qualitative aspects of the business. But what they're really prioritizing is predictability, stable margins. They don't require rocket ship growth. This is not early stage fundraising, right? This is selling a business. So buyers value and appreciate a company that's growing 5 to 20% a year and has stable margins, is EBITDA positive, and also has a very diversified customer base. That's one of the key aspects that buyers look at is the more diversified your customer base, the less risky it is to a potential buyer if you lose a customer, so forth. So in that regard, it actually makes it more of an attractive company to buy, the more diversified the customer base is. And it actually can boost valuation as well, the purchase price. Now, the same goes for the suppliers, by the way. It doesn't get talked a lot about, but you don't want to have suppliers concentration if you can help it as well. Because if one of your suppliers fall through, you might have to stop what you're doing temporarily to get another supplier. So redundancy in suppliers is important too. And so, at a high level, those are the most important things. I mean, the other aspect of the deal that buyers look at is the dynamics of the deal itself. Why are they selling? Why are you selling as a business owner? What's your objective? Are you looking to exit because you're retirement age, or you have an illness, or you have to do some estate planning? Those are the most common reasons to sell. But there are other reasons too. Sometimes you need a partner, and sometimes that partner can help you like take some chips off the table for yourself and your shareholders, but also provide some growth capital. Maybe you want to acquire another business, or you want to grow organically. You need, the capital to initiate and fulfill those new initiatives. So, they look at all that stuff. The other thing that is a key to buyers to understand is, going back to the objectives, willing to stay on as a former owner that's transitioning out. Are you willing to stay on for a little bit, or you want to exit quickly? What's your objective there? And if you do stay on, do you have interest in keeping equity in the company after you sell? Because you don't always have to sell 100%. There's an option where if you work with a financial buyer, you actually can sell a meaningful portion of the company, but still run it with your management team for a period of like 5 years or so. And then you'll do a full exit at that time when the private equity owner wants to exit. So it's almost like a true liquidity event for those types of situations. And it's appealing to a certain type of seller that maybe isn't ready to retire or transition out in the next 1 or 2 years. Maybe they see a 5-year transition plan. In that case, that's perfect scenario for a financial buyer versus strategic, because you actually can get a larger, depending how much equity you keep on the first deal, when you exit 5 years later, that second liquidity event could actually be larger than the first one, depending on how well the company does during at that time. So there's pros and cons to both types of buyers, both types of deals, but we can get into that too if you want to. But at a high level, the quality of the business dictates if the management team is going to stay on, then they're going to weigh the management team quality pretty heavily too, and make sure that the team is complete. Like there's no holes in the team. Like there's got to be a CFO, there's got to be a COO, CEO, obviously, and maybe a head of sales, et cetera, head of technology. They look for all those pieces to be there. And so I guess backing up a second, if you're a business owner, that probably sounds a little daunting, right, Tim? Like that's a lot of stuff to think about.
It does sound a little daunting. Yeah.
It's a big checklist. And guess what? When you hear about in the market companies that sell for high prices or a premium, in most cases, they didn't just one day wake up and say, I'm going to sell the company and let's do it. There was usually a lot of preparation that went into it, sometimes months, if not years, to get to that point. So the business is clean by the time they're in market in front of buyers. And that's where we come in. That's why we're in business. As advisors, part of our value prop here at Growthink is to lead that preparation process for business owners that are seriously thinking to sell and probably want to sell, but they just don't know exactly when. Sometimes you don't have to time the sale. Like it's better to not be in a rush and prepare the company for sale so that you can have the best chance to maximize the value of the business at that time. The last thing you want to do is rush into a sale unless you have no choice. But if you have a choice and you want to maximize value and get a deal done, preparation is pretty much required. You just can't say you're going to sell the business and then see what happens. That's not the best way to do business in the M&A industry.
I just want to recap a little bit here because you dropped a lot of bombs, a lot of nuggets. A couple things. So the predictability of a business is very important. Predictability of revenue, customer concentration, not having supplier concentration, so being diversified enough with suppliers, making sure that there's no holes in the management team, ensuring that you know why you're looking to get out and you can share that message with the potential acquirer, what your objective are of why the time is right, knowing if you're looking for a partner in growth, if you're doing a 2-bite of the apple approach, ultimately ensuring that you're not rushing into any major transaction, that you're taking the time and being buttoned up. Let's turn a corner here and talk a little bit about the strategy of hunkering down and growing or getting out while the getting is good. So what's your take on that?
Yeah, that's another magic question. That's a question that's multifaceted. I think for business owners, a lot of the reasons they sell is because they want to make a lifestyle change. And so that's usually what's driving it. But sometimes they don't want to actually do that and they want to just get out as soon as possible. So depending on the objectives kind of dictates how and when you sell. But timing wise, just the best time to sell is when the company is ready to sell, not when you're trying to time the market. That doesn't work for mergers and acquisitions, unlike maybe in minority startup fundraising that kind of works. Again, the company's quality dictates the buyer interest ultimately. And one thing I do want to mention I forgot to cover, Tim, was another thing to prepare that's very important is the technology systems, the accounting systems. Make sure all the technology is fully integrated, and the accounting reporting capability is very important so that diligence can actually get done on the business. You'd be surprised how many companies forget that part, and they have broken accounting systems that don't sync right with all the internal databases and data and so forth. And so it becomes really clunky, and that does not impress buyers, especially in this day and age. So that is a whole nother module of preparation that needs to happen.
Yeah, I love that quote of quality dictates buyer interest. And it's less about market timing and more about the quality of the deal.
Yes. The other thing I would say, there's a subjective aspect to this, is like for folks that have never done it before, selling a business is one of the hardest things you'll do, maybe as hard as building the business. Well, it's a lot less time, but it's going to feel pretty intense for a period of 6 months to a year. The process takes 6 months to a year on average, beginning to end. The owners have to mentally go in knowing it's going to be, they have to have the expectations set accordingly. But at the same time, if you really want to get a deal done, there's got to be a certain amount of flexibility on the part of the owners too, because if they just hold out for the, playing hardball the whole way through, you're going to lose a lot of people. Buyers will fall off. You might not end up with the right buyer for your company. They might be the highest payer, but they might, rebrand it. They might fire a bunch of people. they might, for lack of a better word, kind of tank your company. So those aspects of the deal are important too. Like, what type of buyer do you want to have for your business, or owner do you have after you sell? Do you care about your employees? Do you care about your brand and legacy of the company? If you do, then maybe it's not good to sell to the highest bidder.
Right, right.
So these are the considerations that owners, they have to think about, the trade-offs, right, between maximizing the purchase price versus, am I getting the right buyer for this company? What do I want it to look like 5 years from after I sell? Do I care if it even exists anymore and it gets folded into another company and there's no, that would be more of a strategic operating company that buys it, competitor, if you will. Okay, so it just depends on what the business owner's priorities are. If it's to maximize purchase price and everything else is secondary, then that's one thing. But if they want more of a balance, then it's a different type of buyer.
Further to demystify for our audience, why don't deals get done?
Lots of reasons, but by far the most common reason is there's a disconnect, or there's too much of a bridge between what the seller is looking to sell for, what the buyer is willing to pay for. So there's a spread there that's hard. It's too wide to bridge, to find the middle ground. So that's where I was saying, if a company really wants to sell and get a deal done, there has to be a certain amount of flexibility, and they have to be willing to give a little bit. Otherwise, it just turns off buyers. Like,
You have any practical examples of scenarios you've seen in your career where, not naming names, but a buyer wasn't willing to flex, and what were those areas they weren't willing to flex on? Because it's more than just purchase price.
Oh, it's definitely more than purchase price, but look, they flex on a bunch of things. I would say that it depends on the structure of the deal that will come into play, because if it's a full sale, a lot of financial buyers don't even get involved in the first place. That's more of a operating company that's going to buy the company. It ultimately depends on what the structure is. It's hard to predict how that plays out until that's decided.
That makes a ton of sense. I
see.
think terms, you mentioned terms, that makes a lot of sense. So if the new buyers want a lockup period, let's say like a 3-year earnout, and the seller only wants to be in the deal for 12 months, that could be a deal breaker. What other deal breakers do you see?
Yeah, the structure is what you're hinting at, which is, is there an earnout? Is there what's called a seller note, which is basically the seller financing part of the debt that's used to finance the deal. It's the equivalent of also like keeping equity, but instead of that, it's actually you're contributing to the debt side of the deal, which I'm getting a little technical on you, but there's a lot of options there. Generally speaking, business owners don't like either of them because they're contingency payments, especially the earnout. And here's the thing, like, psychologically, business owners think, well, I just gave up control to someone, even though I'm still running my company. I don't have full control or influence over the outcome in 1 or 2 years to get those earnout payments. So that becomes a little bit of a tension in the deal too. And that is exactly one reason why a deal would fall through. The valuation might be great, but the owners don't like the structure of the earnouts, of like, well, it's too high of a contingent, and the devil's in the details. Like, a lot of times buyers will structure an earnout like all or nothing payment each year instead of a tiered payment. Like, if you hit X% of the target for that year, you'll get X% of the payout. Some would be all or nothing, black and white. So that becomes a hurdle for getting a deal done for sure. Other things besides valuation and structure that you're going to have: regulatory, environmental. They do diligence on customers and suppliers. So they'll actually interview your customers, your suppliers, to understand the dynamics there, pros and cons. They want to see the good, bad, and the ugly of the company. They do background checks on business owners, of course. Any of these things, that if red flags come up, that could tank the deal by itself.
Yeah.
Right.
Yeah. So let's get into the mind of the buyer. The lower the risk, the higher the confidence. What would you say sits at the top of the pyramid, the top of the ladder for the buyer when they consider risk?
The biggest risk? Oh gosh, it depends on the type of business. That's a hard question to answer because it could be multiple things. If it's a tech company, it could be technology obsolescence.
Yeah, that's great. Right.
Okay. But outside of technology, there are a lot of other things that weigh in there. Gosh, the list is really long. Customer concentration is a risk. Generally, the threshold is above 20% for your largest customer. It starts to get a little iffy with buyers. The only exception, and we're talking mostly financial buyers here in this case, if you're going to get acquired by an operating company, your company will likely, it's going to get absorbed into the larger parent, and that customer concentration kind of disappears because they're part of the large entity now, right? So it's kind of bifurcated. What else? I think I've talked about price, technology, systems. If the systems aren't sufficient, the way to think about it as a business owner is if you're selling to a buyer, the less they have to spend after they take ownership to bring it up to minimum standards across the board in all these areas, the more they're willing to pay.
Mm-hmm.
So this is where the preparation comes in. And, if preparation is done up front and they have no issues across the board, that's going to be the maximum value they're going to get. That's how you maximize value.
Let's talk about confidentiality. How important is confidentiality? And then how does, let's say, a firm like Growthink ensure that there's max confidentiality when this hits the market? Because this is a major concern for sellers.
Absolutely. Yeah, we're very sensitive to that as well. In the reality, we all sign NDAs, but it's kind of like a rubber stamp nowadays. Everyone has to do it. The reality is the process itself dictates how confidential the process can, or how the deal is. So, the more buyers we approach on behalf of a seller, the less confidential it is by nature. Because buyers do talk, even though they sign NDAs, they still do talk. That's the nature of the beast in practice. We can't control that. We have to be aware of it and accept it, embrace it. It really is dictated by the business owner, the seller. Like, what's their sensitivity to that? It's a conversation. And if they are trying to maximize, most of the time, they're less concerned about confidentiality, just finding the buyer that's going to pay the premium, be the outlier buyer, if you will.
Right.
If they care more about the legacy of their company and they're not just maxing out the valuation, then it's more of a balance, right? So it's ultimately up to the temperament of the seller and what their sensitivity is to that.
Yeah.
If they are very concerned about confidentiality, we would do it in a more very targeted process, maybe little by little, going out to maybe 10 buyers at a time, and being very strict about the confidentiality of presenting the opportunity to them up front, making sure before we reveal any proprietary information or the name of the company, that we make sure they're very interested already and they've signed an NDA. So it's an extra verification step for us, the investment bankers, to make sure they're real and serious before we reveal confidential information. That's one end of the spectrum. The other end of the spectrum, like I said, is just a broad kind of shotgun approach to selling the business and finding a buyer that can pay the most. So that's the spectrum.
Let's talk a little bit about the benefits, maybe the positives and the downsides of a strategic or financial buyer. And maybe you can simplify a little bit of that language for the audience as well.
Yeah, another great question. I'm sure these business owners get approached all the time by both strategic and financial buyers. When you hear financial buyers, you're talking about private equity groups mostly, family offices fit in that category. So private equity, they prefer to not do full buyouts. And usually they're buying control of the company, which means at least 51% of the equity, up to a maximum of 90%. And what I mean by that is they do not come in and try to they don't come over and take over the company and run it. They still back the existing management team. They rely on the management team to continue running the company, and they don't actually try to reinvent the wheel or ask them to do things differently. Maybe tweak on the margin and be a resource and help, but they're not trying to run the day-to-day business. That is not their objective at all. Okay, they might have quarterly check-ins or something and be available on call, but beyond that, it's not as much of a burden as a lot of these folks think. There's some perception out there that they're going to be on you every day, like white on rice, type of thing, constantly driving you. That's a VC that does that, probably not private equity. So the financial buyers, the pros of them is, like I said, it's like a two bite of the apple type of transaction where you can actually take some chips off the table now and still run the company with your team while having basically a strategic partner that specializes in basically being a strategic consultant for your business and also helping you to think about new ways to grow it organically or inorganically. And if it's inorganic, they are experts in mergers and acquisitions and actually provide someone from their team to like drive that for you or help lead that for you. So you're not just getting capital with a private equity group, you're getting resources, you're getting strategic guidance and support along the way. And turns out to be very valuable. So let's say that they buy 80%. Because the selling management team is staying on for the next 5 years or so, they really want the management team to have skin in the game after they sell, right? So that's why their upper limit usually is like 80 to 90% is the max they'll buy. They want the management team to own the other 10 to 20% minimum, up to 49%. Because then the interests are aligned, right? All the way through. Everyone's wanting to get to, the maximum value in 5 years. And how do we do that? Just kick butt type of thing. The downside to financial buyers, you're maybe not going to be comfortable if you've always been accountable to no one before running the company. Suddenly you have to be accountable to someone during that 5-year period. Now, like I said, they're not going to be riding the management team constantly. It's more like a regular check-in every month to 3 months and just providing support and resources and expertise. So on the downside, though, they have reporting requirements for their businesses that they buy. So, just the accountability piece, I think some business owners who or anyone suddenly have to do that.
Yeah.
So that's one of the only downsides really with PE though, compared to what you get in return.
Yeah. And there's a big emotional component into this whole thing. So let's just touch very briefly upon emotions. And I'd love to hear your perspective on how much emotions play a role in all of this beyond just the technical financial part.
Yeah, that is underappreciated and not talked about a lot because everyone's so focused on the business fundamentals and whatnot. But the psychological and emotional aspects for a business owner is pretty substantial. And it's interesting because if they never tried to sell before and then they start selling, trying to think about the decision to sell or in the process of selling, it becomes an emotional roller coaster for them because a lot of these businesses they've owned for decades and have run it. Maybe they founded it or it's a family-owned business. And so to think about letting go of their baby, it's almost like a baby to them, like a kid. It's very emotional. They go through periods of like uncertainty of like, do I really want to sell? Am I ready to do this? What am I going to do after? I spent all day working, like, what am I going to do after? So it's a lifestyle thought process. It's like an emotional thought process of like a feeling like you're losing. It's a loss, like a sense of loss that they have to work through, right?
Yeah.
And so because they're so emotionally invested in their businesses, it's like the most important thing in their lives, sometimes even more important than spouses. They won't admit it, but you know what I mean?
Yeah, it's almost like when is very existential, right? Because how to sell a business, we get a valuation, we put a process together, we look at these numbers, do these things that we talked at the top of this call. But when is very existential? Because you're right. What do I do after this? And this has been my identity the whole time. And we were talking about reasons why deals don't get done. How much would you say that emotions play a role in deals not getting done?
A lot. I like to equate mergers and acquisitions or selling your company to almost like the dating world.
Mm-hmm.
You're going to come in with some baggage. You're going to come in with some preconceived notions. You're going to come in kind of nervous and anxious. And then throughout the process, you're never really sure how it's going to play out. But once you find the right buyer, it gets exciting, and then you start to like get the anxiety starts to fall away and you start to like see the light at the end of the tunnel. But in the beginning, it's an emotional roller coaster and the psychology is definitely tested on, do I really want to do this? Is now the right time? Especially if they have family in the business. Keep in mind, a lot of businesses are family owned, private companies. And if they have kids in the business, that's a whole other consideration, right? That they have to worry about. So every deal is unique. They're like fingerprints. And so depending on the dynamics of the deal and all the circumstances will drive, what the deal will look like, how it'll be structured, what the outreach process will be like. And that'll all trickle down to it'll impact the emotional stability and psychology of the business owners day in and day out.
How important would you say it is for a business owner who's, maybe even considering going through the process? Maybe hopefully they're a year or two, three out, but how important is it for them to start having conversations like this with folks like yourself?
Well, it's never too early. We always like to say that, because you got to start somewhere. And if you've never, as a business owner, never tried to sell before, you're in for a lot of learning and a lot of counterintuitive things about the process. First being that a lot of business owners think they know who the right buyer is. And a lot of times the company or buyer that buys it is not a company that's on the radar. And that's a reason why you run the process. A process is basically a discovery process of what the market likes and doesn't like about your company and what it's willing to pay. There's no way to fully predict that accurately. That's why a process has to happen. And
Yeah. Well, I just want to restate that because I think it's great. The process is a discovery process of what the market likes and doesn't like and what they're willing to pay. So if you're a business owner out there, a potential seller, you must run a process in order to learn what the market likes, doesn't like, and is willing to pay. If you don't go through that process, you're going to be blindfolded walking through this.
it's a good point. Yeah, selling to a one-off buyer outside of an auction process is what we're calling it. You're not going to get the maximum valuation for sure, and you may not find the right or ideal buyer. What's great about an auction process is that it drives valuation because of the competitive nature of it. Buyers know, okay, by the nature of the process itself, when they receive a big summary of the business from us, they know it's an auction process versus like a teaser, a little one pager or summary or something. So they know if they want this company, they have to bid up for it.
Right.
Whereas if they approach the business owner directly and said, hey, we want to buy your company. Let's say the business owner said, sure, I'll explore. And it actually gets an attractive offer, but that's not in a process, no competitive boost to the valuation, right? So there's no way to know what you left on the table if you do a one-off ad hoc buyer process.
Yeah.
Just because you think you know who's the best buyer doesn't mean they're actually the best buyer. It usually doesn't work out that way.
Yeah. And the first buyer could potentially come in for more if there was a competitive process put together, correct?
Absolutely. You got to get the hook into them first. And once they fall in love with the company and they feel like they have to own it, you get a couple, 2 or 3 buyers like that, they bid up the price. Absolutely.
Yeah.
Just like in the movies you see, it actually happens.
Yeah. It's a bit of psychology, right? I mean, this is sales. It's sales just at a grand scale. The stakes are probably higher than they've ever been because this is your life's work in most cases. Especially if you're family owned, this is your identity, but it is still sales. And a sales process is a sales process. There's a series of things that need to be done in a particular order. There's a lot of psychology, a lot of emotion. Not all deals are done on logic. We know we make purchases emotionally and rationalize it later. So I would say to any seller of their business to understand that before they even step into the process and know that they're going to be confronted with the rational and the emotional at the same exact time. And we need to get clear on that before we even break ground and start figuring out what this thing is worth and who would buy it.
Absolutely. Absolutely. One of the risks I didn't mention, if we're going to circle back for a second, is due diligence is another reason why deals fail. And it goes back to preparation. So due diligence is as rigorous as it's ever been in my 14 years of doing this. And the only way to survive that and get a deal done is to make sure that all the ducks are in a row, all the I's are dotted, T's are crossed. That only comes with preparation, like we talked about at the top of the call. And it's a leading reason why deals don't close is during that process. the buyer discovers something that wasn't, it was like an unpleasant surprise when they discovered it.
Right, right.
Right?
So even if it's unpleasant, you should be aware of it and present it, be forthright and talk about it. Because I think you can get over these situations by having a dialogue and say, this is what happened. This is our plan to get over this thing. We want you to be aware of it. Like it
Uh-huh.
may not be the end of the deal or the end of the world if you treat it, with respect.
Exactly. It's important to identify every aspect of the business to a buyer up front so that down the road there's no unpleasant surprises. And it's more efficient process too. If there's something about it they don't like and it's like a non-starter for that buyer, then it's
Right.
better to know earlier than later.
If there's a seller out there and they want to get into the game and start figuring out what this thing's all about, how does someone get a hold of you? How does someone work with Growthink? What does that look like?
Well, you can find me on our Growthink Capital website, but I'm also on LinkedIn, of course. Feel free to reach out to me there. Happy to have a conversation informally, confidentially, just to just talk about some of this stuff and answer questions.
Awesome. Thanks for joining. And if you're new out there, please like, comment, and subscribe. And we will put the contact information for Eddie and myself down below. Thanks, everyone.
Thanks. Appreciate it.